Silver didn't slowly recover, it bounced like it hit concrete. One day it's getting destroyed, 40% gone in 3 days, traders wiped out, screens flashing red, people saying, this thing is finished. And then, almost immediately, it turns around and jumps hard, gold right behind it. That kind of move should make you stop and ask a simple question. Who was buying? Because crashes don't reverse like that unless someone was waiting. Last week felt like chaos if you were watching from the west. Silver falling minute by minute, gold dropping hundreds of dollars while people were still waking up, everything tied to risk selling at once. It felt emotional. It felt random. It wasn't. It was mechanical. Too much leverage met a sudden rule change. Margin requirements went up. Traders who were fine the day before suddenly weren't. And when you don't have the extra cash, you don't argue. You get sold out. Once that starts, it feeds on itself. Prices drop. That triggers more margin calls. Those force more selling, which pushes prices lower again. It's a loop, and it doesn't care if the asset is good or bad. It just keeps going until there's nothing left to liquidate. That's how silver went from 121 to the low 70s in a blink. But here's where the story stops lining up with the headlines. Because while silver was getting dumped in New York and London, it wasn't being dumped everywhere. In Asia, physical silver was trading much higher. Not a little higher, a lot higher. Same metal, same week. Two very different prices. That's not how a global market is supposed to work. If silver were truly crashing, buyers everywhere would be backing away. Instead, buyers in one part of the world were paying more, while buyers in another part were being forced to sell at any price they could get. That's not panic. That's transfer. Think about that for a second. While traders were getting margin calls and hitting sell buttons just to survive, someone else was calmly stepping in and buying the same metal at a premium. Not chasing, not guessing, buying with intention. That doesn't happen by accident, and it tells you something important about what actually broke. It wasn't silver, it was the pricing system on top of it, because silver isn't just a financial idea, it's a material. It goes into real things. Solar panels, electronics, power systems, medical equipment. You can't replace it easily, and you can't pause demand just because markets get messy. Factories don't care about charts, they care about deliveries. So when prices collapsed to levels that didn't make sense for real-world buyers, those buyers stepped in. Immediately. That's why the floor didn't keep falling. That's why the rebound was fast instead of weak. And that's why this crash feels different from the ones people like to compare it to. If this were just a bubble popping, the aftermath would look ugly for a long time. Slow bounces, weak buying, people afraid to touch it. That's not what happened. Instead, silver snapped back with strength. Gold followed. Physical demand tightened instead of loosening. That's not what dying markets do. Now zoom out a bit. This didn't happen in a calm world. It happened while governments are already nervous about resources, about supply chains, about depending on materials they don't fully control. Silver sits right in the middle of that problem. Most people still think of silver as coins or jewelry. That's outdated thinking. Today, most silver gets used up. Once it's built into products, it's gone. And here's the uncomfortable part. The world has been using more silver than it produces for years. That gap hasn't closed, it's widened. You don't fix that with price drops. You don't fix it quickly. New supply takes a long time to come online, sometimes a decade. So when prices collapsed last week, it didn't suddenly make silver abundant. It made it attractive to anyone who actually needs it. That's why the selling stopped where it did. Now add one more detail that most people missed. While all of this was happening, major players weren't pulling back from metals. They were repositioning closer to where physical demand is strongest. That tells you something without saying a word. Big money doesn't chase headlines, it follows flow. It goes where the real action is, not where the loudest opinions are. And right now, the real action isn't in futures contracts flipping hands, it's in who's quietly securing supply. This is why the crash matters, but not in the way people think. It wasn't the end of a story, it was a reveal. It showed you how fragile paper pricing can be under stress, and it showed you how quickly reality steps in when prices stop making sense. Right now, there are effectively two versions of the same market. One driven by leverage and rules, one driven by need and planning. They're not aligned anymore, and markets don't stay like that for long. So what you're really watching right now isn't a bounce, it's a standoff. On one side, you have the paper market, fast, loud, emotional, driven by rules, leverage, and machines that don't care why something is being sold, only that it has to be sold. On the other side, you have the physical world, slower, quieter, focused on one question only. Do we need this material, and can we get enough of it? Those two worlds usually move together. Last week they didn't, and when that happens, it tells you something important about where pressure is building. Think about what the crash actually did. It didn't scare real buyers away. It scared out anyone who was overextended, anyone who needed borrowed money to stay in the trade, anyone who couldn't survive a sudden rule change. That's painful, but it's also revealing, because once forced selling ends, what's left is choice. And the moment choice came back, buyers showed up. That's why silver didn't keep falling. That's why gold didn't collapse further. That's why the rebound wasn't slow or timid. Real demand stepped in and said, this price doesn't make sense. Now zoom out even more. The world hasn't gotten simpler, it's gotten more electric. more digital, more dependent on materials that can't be replaced easily. Every year, more systems get built that require silver and copper just to function. That trend doesn't reverse because traders panic. And governments know this. That's why you're hearing more talk about critical resources and supply security. Those phrases don't show up when things are comfortable. They show up when dependence becomes risky. Silver is no longer just a trade. It's a component, a bottleneck, a quiet vulnerability. That's why last week's move matters far beyond the chart, because it showed you how fragile pricing becomes when too much leverage sits on top of something that's actually scarce. And it showed you who reacts first when that illusion breaks. Retail traders react emotionally. Funds react mechanically. Strategic buyers react calmly. While one group was scrambling to exit positions, another group was calmly absorbing supply. Not because they thought prices would bounce tomorrow, because they think in years. This is where a lot of people get stuck. They want certainty. They want a clean answer. Up or down, buy or sell, safe or dangerous. Markets don't work like that. What they do instead is send signals. And the signal right now isn't about direction, it's about disagreement. When prices fall and demand disappears, that's a warning sign. When prices fall and demand increases, that's something else entirely. That's what happened here. And it explains why the recovery felt different. This wasn't a hopeful bounce. It wasn't people buying the dip because they saw a green candle. It was people stepping in because the price crossed into territory that didn't line up with reality. That's an important distinction. Now that doesn't mean there's no risk ahead. There is. Volatility doesn't disappear after a shock like this. It usually comes back in waves, sharp moves, fast reversals, headlines changing every day. Anyone pretending this is smooth sailing from here is lying to you. But what did change is the makeup of the market. The weakest hands are gone. The most leveraged positions are gone. The froth got burned off. What remains is a market that's thinner, more sensitive, and more honest. That can still be dangerous, but it's a different kind of danger. And here's the part that really matters going forward. If physical demand stays firm, if inventories remain tight, if buyers keep stepping in on weakness, if prices in different parts of the world keep disagreeing, then the paper market will eventually have to respond. Not because it wants to, because it has to. Paper prices can move fast, but they can't ignore reality forever. When too many contracts point to something that can't actually be delivered cheaply, pressure builds, and pressure eventually finds a release. That release doesn't always look dramatic at first. Sometimes it shows up as persistent premiums. Sometimes it shows up as quiet accumulation. Sometimes it shows up as big players moving closer to where physical trade actually happens. All of that is happening now. This is why last week shouldn't be filed away as just another crash. It was a stress test, and the system didn't fail evenly. The parts built on leverage cracked immediately. The parts built on real demand didn't. That difference matters more than any single price level. Most people will wait for things to feel calm again before they pay attention. By then, the story will already be written. What matters now isn't prediction. It's awareness. Awareness that not all selling means something is broken. Awareness that not all prices reflect truth. Awareness that when two versions of the same market stop agreeing, something has to change. Silver didn't just survive a crash. It exposed how disconnected pricing has become from reality. And once you see that, it changes how you read every move that comes next. Because the next big shift rarely announces itself with a warning. It shows up quietly in who buys when everyone else is trying to get out. And last week made that very clear.